What's going on, everyone? Welcome back to the channel. Today, we need to talk about SOFI. Because while the sea of red in the markets might have some people shaking, the actual data is telling a very different story. Let's look at the tape. SOFI slipped about 2.2% today, closing at $15.90. We saw a high of $16.33, but the volatility really kicked in thanks to the CPI numbers. Headline inflation came in at 6.5%, not exactly what we wanted to see. And the market is now pricing in a 35% chance of a rate hike by January 2027. But here's the thing. While the broader market is panicking about macro trends, SOFI's internal engines are humming. First, let's address the downgrade. Truist lowered their price target to $17 with a hold rating. Now, usually, a lower target sounds bad, but look at the math. With the stock sitting under $16, that $17 target represents immediate upside. And the 3-month consensus? It's still locked in at over $20.87. That is a massive 31% gap between where we are and where the experts see us going. But more importantly, follow the leader. Anthony Noto isn't just talking the talk, he's buying the dip. We just saw another Form 4 filing showing Noto buying shares for the second day in a row. When the CEO is reaching into his own pocket while the market is fearful, that is the ultimate signal of confidence. Meanwhile, shorts are playing a dangerous game. We have 165 million shares shorted, about 13% of the float. They doubled down yesterday, but as we've seen time and again, a crowded short position is just fuel for the next squeeze. On the technical side, the stochastic RSI is looking extremely oversold. We are trading between key support levels, and while we closed just under the 10-day moving average, this consolidation feels like the calm before a breakout. If we can push past $16.60, the run to $18 is wide open. So here is the takeaway. The market is giving you a gift. You've got a CEO buying shares, institutional dark pool activity picking up, and technicals that suggest the selling is exhausted. Don't let the headlines distract you from the fundamentals. SOFI is building something massive, and these price fluctuations are just noise on the path to much higher levels. Now, I want to take a step back and look at the bigger picture, because if you're only focusing on today's 2% drop, you are missing the forest for the trees. We are currently in the middle of a fundamental shift in how this company is valued, and the smart money is already positioning for it. Think about the Q1 earnings we just saw. SOFI didn't just beat expectations, they shattered records. We're talking about $1.1 billion in quarterly revenue, a 41% increase year over year. Net income didn't just grow, it doubled to nearly $167 million. We are looking at a company that has delivered 9 straight quarters of GAAP profitability. In the world of fintech, that isn't just good, it's elite. Yet the stock fell after earnings. Why? Because the market is obsessed with the tech platform segment. Yes, Galileo revenue was down 27% because of the Chime exit, but that was a known transition. What the bears are ignoring is the massive pivot toward a balance sheet heavy model. SOFI is now funding 96% of its loans with its own deposits. That is a game changer. It means they aren't at the mercy of the warehouse lending markets anymore. They are a bank with a tech company's growth rate, and that is a combination Wall Street still hasn't figured out how to price. Look at the membership growth. 1.05 million new members in just 3 months. We are sitting at 14.7 million members. And here is the secret sauce. 43% of new products are coming from existing members. That's the financial services productivity loop in action. It costs SOFI almost nothing to sell a second or third product to someone who already has a direct deposit with them. This is why their EBITDA margins are expanding to 31%, even while they ramp up marketing. And let's talk about the hidden catalysts. There are reports circulating about SOFI acquiring Primary Bid to expand into retail IPO access. This is Anthony Noto's vision, an everything app for your money. He wants SOFI to be the digital version of Goldman Sachs for the everyday person. When you see him buying shares at $16, he isn't just trying to support the stock, he's betting on this ecosystem. Also, don't sleep on the student loan segment. We just saw record student loan originations of $2.6 billion. With the political climate shifting and refinancing finally becoming a reality for millions of high-income earners again, SOFI is the primary beneficiary.
They have the highest quality borrower profile in the industry. The bears will tell you that higher for longer interest rates are a headwind. I'm telling you they are a tailwind for SoFi. Why? Because their net interest margin actually increased to 5.94% this quarter. They are earning more on their loans while their cost of funds is dropping as they replace expensive debt with your deposits. So when you see a hold rating with a $17 target or a volatility spike because of a CPI print, ask yourself, has the story changed? The answer is a resounding no. In fact, the story has gotten better. We are looking at a company guided to grow earnings by 40% annually through 2028. You are getting a high growth tech platform at a price to book valuation that rivals stagnant legacy banks. This isn't a trade, it's a generational shift in banking. The market is giving you a chance to build a position while the experts are still arguing over last year's data. Stay the course. The fundamentals are screaming buy. The CEO is buying, and the record-breaking numbers are doing the talking. We're not just looking for a bounce, we're looking for a re-rating. Don't let them shake you out right before the turn.